time now to our special conversation, Market Masters. Today we have with us the Citi India top team. Surendra Goyal, Head of India Research, Samiran Chakraborty, Chief Economist-India, and Kunal Shah, Director, India Bank's Financials. Gentlemen, great to have all of you with us. Thank you so much for joining in. I could start with the banks question because that's become the hottest topic in the last, 48 hours. But we'll come to that. We'll come to banks in just a bit. Surendra, let's open with you because looking at some of your latest notes, it's quite evident that you folks have turned a little positive on the market and you're finding valuations also more palatable. So let's start there. Where does India stand now after this 5-month-old correction?
Sure. Thanks for having us on the show. Yes, we have turned more positive on India. Around a couple of weeks back, we turned overweight on India in our within our EM strategy framework. And there are a bunch of reasons driving that view. Firstly, growth did slow down, but we believe it's a cyclical slowdown and we should see improvement going forward. We have already seen certain actions by the RBI, government, etc., which gives us more confidence on the growth outlook improvement going forward. Of course, these things do take some time to reflect. So it will take time, but the outlook seems to be improving. From a EM perspective, what we noted in our US marketing trip as well, and even our regional data seems to support it, is that EM funds in general are underweight on India. And our regional team does this analysis on a monthly basis. And EM funds that we track within that study, they are around 150 basis points underweight on India, right? And if you look at the last 20 odd years, India has mostly been an overweight. And even if it has gone to underweight, it has been very briefly a few times. So that setup also is more favorable. On valuations, we have seen the market pulling back, like it had gone to highs of Nifty 22, 23 times earnings at the peak. Now it's kind of come down to 18.5, 19 times. So that looks a lot better as well from a valuation standpoint. And then finally, from a flow perspective, we have seen a fair amount of outflows since October. But the outflows on FII side seem to be slowing down. And so far, the domestic flows have been pretty resilient. So when you kind of put everything together, there has been a valuation correction. We believe growth should see pick up as we go forward. And the setup from a positioning perspective is also favorable. So that's the reason why we are increasingly, we have turned more positive on the market. And we recently changed our stance to overweight within our EM strategy.
So Surendra, just to continue that point, you're overweight India. So if someone has to buy Indian stocks or give us the way you would construct your portfolio, what are the sectors that you like and which ones would you avoid now?
Yeah, sure. So what, like in terms of sectoral overweights and underweights, where we are overweight today, firstly is financial services, where we think that things are kind of gradually starting to improve. And again, it's a modest improvement, but it's not getting worse. And valuations in the context of the market or in the context of history are quite attractive. And again, we are more positive on the larger names in that space. That's the first pocket. Secondly, there are a couple of sectors where there is good earnings visibility, be it the telecom players or the domestic healthcare space. So those are, again, another space or other spaces that we like. And then we have cement, where we turned positive a couple of months back or maybe 3 months back. So there, again, our view was that things should improve, should pick up from here. And last year was a weak year. So stocks had corrected. So yeah, those are some of the sectors. And then beyond that, there are some specific themes also that we like. Like, for example, travel is one space where we think the domestic travel market is quite strong. And there are plays on that which should continue to do well going forward. Overall, like IT services and consumption in general, beyond a few pockets, those are the two sectors where we still have a relatively more cautious view. So that's how we are positioned right now.
Well, Surendra, let's push a couple of those points a little ahead then. You're broadly focused on the domestic themes. Cement, as you said, the healthcare space as well as what you're looking at. Let's, focus on a couple of things that you said. One is the rotation trade, the money moving to China. And China has done a relative outperformance in the last 6 to around 8 months. Bulk of that rotation trade, is it done? And since FIs have been, underweight on emerging markets on the whole, do you think it makes a strong case for them to come back? And should we see this big outflow gradually start reversing in the months to come in 2025?
Sure. So, see, there are a few variables here to keep in mind. Like if you look at the dollar had gone from, say, DXY had gone from 100 odd levels to 108, 109 levels a month back or so. And from there, it's kind of retraced back to 103, 104, which is usually relatively better from a EM perspective. So that's something I would watch out for. And we have seen kind of outflows kind of slow down very meaningfully in the recent past. So again, we are monitoring trends, but overall it does look that at least things are not as tough from a foreign flow perspective as they were in October, November, December. So that's something to watch out for. Secondly, on the other part of your question, China versus India, again, obviously China, if you look at MSCI China this calendar year, there is a 20% outperformance versus India. And a lot of that has to do with the Chinese technology stocks, right? If you look at the tech index there, it has outperformed the broader market there by another 10 to 15%. So it is a tech-driven rally. So when we talk to clients, I think the market, Chinese market from a valuation perspective was obviously low in the historical context. So there is interest. But I think from an India perspective, what is really required is the visibility of a growth pickup. For a lot of investors we talk to, India continues to be a secular play within the EM space. Valuations had gone higher, and there was a cyclical slowdown, and that is what resulted in people taking off money from India, even within the EM framework. So I think that is what really needs to be visible, the growth pickup, for people to be more interested in the Indian market.
Okay, all right. Another level that we look at, the Nifty, well, we have come down from around that 26,500 or closer to around 22,500. What's the year-end target on the Nifty itself, given that earnings should come back, capex spends are picking up, the RBI is injecting liquidity as well? What's the level we should be working with for the next 12 months?
Sure. So we have a published target of 26,000 on the Nifty, which is like, say, 15-16% upside from current levels.
Okay. All right. So still looking at 26,000, perhaps by the end of the calendar year. Got that, Surendra. Let me come to Samiran for a couple of questions. We're talking about this growth slowdown. Samiran, so where do you think we're heading next? Because now we have a turbocharged RBI. I think your own models talk of 2 rate cuts somewhere in the middle of this year, 25 basis points, 2 rate cuts. There's this big liquidity bonanza just today. This big OMO is happening. So you think that will sufficiently propel us forward to meet our targets? I don't know. A lot of people say the fourth quarter sort of asking rate is too high. We'll have to grow at 7.5% to meet the full year targets for FY25. But given the pace at which the RBI is moving now, what do you think about growth prospects for the next year?
So from a policymaker's perspective, there are 2 different tracks that they're working on. On the fiscal policy side, we have seen a personal income tax cut, which is worth about 30 basis points of GDP. And from the monetary policy side, again, there are different approaches being taken. First is that the exchange rate has been allowed to adjust back from the overvalued levels to a much more fair value level now. Second is that the liquidity easing has been very, very consistent and much stronger than what market expectations have been. Third is the rate cut process has started. And fourth is there has been some relaxation on the macroprudential regulations. Now, this package in itself could be worth about 30 odd basis point of GDP, just from the perspective that 50, 75 basis point of rate cut should bring down the borrower's borrowing cost by that much amount. So 30 basis point of GDP from the fiscal side and 30 basis point of GDP from the monetary policy side could be the immediate boost to the household's purchasing power, so to say. And then if this liquidity finally kicks into higher credit growth with a lag, then that can be another booster to overall growth. So we think that 6.5 to 7 kind of growth for next year is quite doable. Just on a small note, the estimated fourth quarter GDP number is probably not that important a variable to look at, because the first 2 quarters data will get revised as we move into the full year number to be released in May. Once that adjustment happens, then the whole profile of the quarterly numbers could be much more stable.
So, Samiran, hearing you talk about our domestic engines, one feels very, very confident, right? Because the twin engines are firing, both fiscal and monetary. And like you said, 30 plus 30, that's 60 basis points for Philip to GDP straight away. But now we have to superimpose the global uncertainty and this absolutely dizzying, crazy tariff business. And we don't know where the parlays end up finally between India and the US. There's still a negotiation for a trade deal, so we don't know what the final numbers will look like. But even if we go with absolute reciprocal tariffs, what's the hit that will have to be perhaps penciled in, and will local growth still more than make up for it?
This is a very complicated exercise with incomplete information because we just don't know how the tariffs are going to be imposed on different countries, whether this is going to be sector specific or it is going to go down to the product specific levels. So what we have done is we have done a very simplistic analysis of equalizing the weighted average tariff rates of both the countries. US will probably have to then increase tariff by about 8 percentage points. And given some elasticity estimates that we have, we think that's worth about $7-8 billion of impact on India's export, everything else constant. That's about 0.2% of GDP. However, we are very much conscious that this will not be as simple as it looks like. This game could be played from India's perspective by cutting down import duties also on some of the items. There could be, in fact, we think that beyond the tariffs, what is more important is that if India starts purchasing more of US energy and defense, that's a better way to reduce the trade surplus that India has with US. So it's too early to get into a very precise assessment of what the direct impact is going to be. But what we are also worried about is the indirect impact, because this uncertainty, the longer it lasts, it will affect private investment, it will affect markets, it will affect, through a negative wealth effect, the consumer behavior as well.
But Samiran, just to complete this point, in your projection of, I think, 6.6%, right? For FY26, you're at 6.6% GDP growth. What impact, if any, of this tariff issue have you factored in to get to that number of 6.6 for next year?
So at this moment, we have put it more as a risk factor rather than putting it into our baseline.
Okay.
So that's 0.2% of GDP. You can think of that more as a risk.
All right. Samiran, one more point on the RBI cuts. I think you're factoring in 2 more cuts, right? What if the Fed doesn't move at all? You'll have considered that as well in your model. 2 rate cuts is what we're going to get, irrespective of what happens?
So in fact, we have used a very operative phrase that at least 50 basis point of rate cuts. Our Citi House view on Fed rate cut is 5 rate cuts this year. So we have taken that into consideration as well. However, I must say that at this moment, the RBI, the way they're positioning itself on the growth and inflation dynamics, it looks like there is scope for rate cuts in India, regardless of what happens in US. India's capital flows are less interest rate sensitive than growth sensitive. So if we can get our GDP growth numbers up, we'll start seeing the capital flows come back, and that will stabilize the BOP, that will stabilize the currency. We need not worry as much on the rate differential with US at this point of time, given where our macros are.
You said 5 Fed rate cuts or 5 rate cuts from RBI?
Fed rate cuts. I mean, we have a view of 5 rate cuts in US this year.
Oh, this year. Okay, got that. That'll be quite the bazooka for the markets. But Kunal Shah, Director, India Banks Financial at Citi, has also been patiently listening in. Kunal, it's all happening in the banks and it's all happening with Innocent Bank. We know your preferred financials include HDFC Bank and ICICI Bank and a Kotak Mahindra Bank, and not in Innocent Bank. But give us your thoughts on what's transpired in Innocent Bank over the last 24 hours, what your conversation with investors are, what are they doing with Innocent Bank? Have they just thrown in the towel now? Share your initial thoughts on the fiasco that's played out.
Yeah, so in terms of the filing, we have seen that there has been discrepancy to the extent of 2.35% of the net worth. And that will be accounted for in 4Q earnings. That's what they indicated in the call. So people are looking forward to how the earnings are going to pan out over next 1 or 2 quarters. And the other aspect is in terms of the succession plan. So now post Mr. Katpalya, who takes up, who's coming over, I think that's going to be the key monitorable as we move forward over next couple of quarters.
Okay, Kunal, what about the big call you made in the recent past, last couple of weeks? Everyone was looking at stocks that have corrected and valuation-wise have become fairly okay. And SBI was one such name. Did a big change of stance on that one. Tell us more about that. Valuations comfortable, decent return ratios, and you have credit growth as well. That's the big call, right?
Yeah, so overall PSU banks, when we look at it, valuations have come off a bit, and we will see them getting the benefit on the credit growth side as well. And credit cost, when we are looking at for the PSU banks, that has been relatively low compared to their historical past. So all that is helping them in terms of sustaining the ROAs for PSU banks.
Surendra, I want to come back to the headline point that you made on FPI selling and the fact that the positioning is at now multi-decadal low, not even multi-year low. Aside of the fact that obviously this is tactical positioning, right? I mean, whether it was the home market bias, whether it was some tactical quick shifts to China, which one understands. Aside of that, is there anything else that FPIs have sort of had an issue with in India? There's been some murmur on taxation, for instance. We also hear some murmurs about how registering in India is very time-consuming and difficult. But I don't know, maybe these murmurs also come through when a market is falling. In a rising market, you don't hear them. But what's your sense? Any other issues that are bothering FPIs?
Yeah, so I think I just add the point there that India's weightage in the EM indices has also gone up substantially. Okay, so say 5-6 years back, India's weightage used to be 8-9%, today it's 17% or so. So the weightage of India has gone up substantially, so that also kind of needs to be kept in mind. On the other points that you mentioned, again, I don't think a lot has changed in the last 3-4 months. Okay, so to that extent, I think as long as investors see the secular growth in India that they come for, I don't think those will play a big role, at least from a medium-term perspective, right? If you think about like Indian markets, any major index in the last 15 years or so, there has been like low double-digit, 11, 12, 13%, depending on which index you look at, that kind of earnings compounding. And that, I think, remains very important. If you see where the market pulled back and where FI flows happened, one of the things was the cyclical slowdown, right? But the fact is FY25 earnings have seen a moderation versus the start of the year expectation of Nifty delivering low double-digit growth will possibly end up with mid-single-digit growth. So to me, earnings moderation was one of the reasons, in addition to the stronger dollar and then later on China bouncing back. I think a lot of things came together, but the most important variable that I'm watching out for is earnings growth visibility. As that improves, I think that is what really gets people back into India.
I absolutely agree with you. At the end of the day, I mean, earnings speak for themselves, and at times they can speak the loudest in the room. Speaking of which, for FY25 is over, like you're saying, it's been a disappointing year, right? Maybe we'll get 6-7% at max. FY26, what's the growth that you're penciling in? And the larger question, do you believe this market can still keep compounding earnings at, say, 12 to 15% every year?
So, see, what we are expecting, what our team is expecting is a low to mid-teens kind of a growth next year, FY26. And again, the drivers, again, Samiran kind of spoke about the view on GDP. And we should see an improvement pretty much across quite a few sectors. So to that extent, that's what is really required. You need to see the visibility of earnings kind of getting to that number. We have been in an environment last few quarters where earnings have been revised down. So I think stability in the earnings outlook is the first thing we would watch out for. So that, I think, that number staying at low to mid-teens, I think that is what is really required for the market to find support and start going up from here. Medium term, I think low double-digit growth still possible in our view. Like if you look at nominal GDP growing at 10-11%, which is what the expectations are, then I think a growth which is somewhere in that territory. Of course, it could be volatile year to year, depending on how each of the sectors move. Particularly, commodities do add a fair bit of volatility and so on. But I think that kind of a medium-term compounding is possible. And that's what really makes India attractive from a EM and investors' perspective.
Samiran, finally, I want to ask you this because this is a new game in town, right? First, it was US exceptionalism and the numbers were supporting it. Then there was a lot of the talk of Chinese stimulus, and then you had a tactical China trade. But Europe, like I said, is literally the new game in town. I mean, the amount of money that's pouring into European equities now, and we're seeing what's happening with German bond yields as well with this whole so-called rearmament exercise. Do you think this is meaningful from a near to medium-term point of view, or is this just the market getting excited because we've not seen anything out of Europe in so long?
Yes, at this point of time, it's all about announcements. The next in line would be about trying to find the funding for this. At this moment, most of the funding is coming out of the national budgets rather than any specific fund at a European level for it. So we'll have to see which country has how much space in their budget to do these things. We are already seeing that countries which are closer to Russia are announcing a much larger defense plan compared to the rest of the countries. So that's the second part, which is the funding part. And then the third part would be the execution part on exactly how this money is going to be spent. If Europe just ends up buying or importing these armaments from somewhere else in the world, then it does not add up to the European GDP as much. But if this leads to more production within Europe, then the growth outlook becomes stronger. Our European economists, they think that the near-term growth impact for 2025 or 26 is relatively low, in the range of about 0.2 percentage point of GDP only. But if you move to 2027-28, then the impact could be more meaningful at 0.5 to 0.9% of GDP. In the context of Europe, which anyway grows only about 2% or so, this could be a very meaningful push-up in GDP growth if it actually happens.
That's very, very interesting. That's helpful perspective as well. I mean, really explains why the equity bulls are suddenly rushing and piling into European equities on that hope of that GDP boost coming through. But we hope, of course, that India continues its charting its own growth story as well. Gentlemen, thank you very much. It's been a pleasure having you on the show. Thank you for all the perspective.